Most business in the UAE are failing at the corporate tax return compliance just because of some avoidable mistakes that they make before starting the return. And the worst part is these mistakes gets highlighted only when FT scrutiny or audit comes in. So in this video, I will walk you through the most common corporate tax readiness mistakes that can cost your business money, time and compliance headache. Hi everyone, welcome back to the channel. If you are running your own business or working as a finance manager in UAE, and if you are about to file your corporate tax return, then this video is extremely important for you. Just to be clear that this video is not about the how to file corporate tax return step by step in the FTA portal. We will cover that in a separate video. Here we are focusing something more important. In this video, our focus is on corporate tax return readiness, specifically the key documents, records, reconciliation, tax computations, elections, and compliance requirements that every business should have in place before starting the corporate tax return filing process. Even with enough time, many businesses still struggle to submit the corporate tax return correctly. Here are some of the mistakes that you must avoid while filing your corporate tax return. First mistake, incorrect taxpayer profile on FTA portal. Before starting the corporate tax return filing process, business should verify that the taxpayer profile on the FTA portal is correct and up to date. Business should verify the following information in section 1 of the CT return before proceeding with the return filing process, such as legal entity name, trade license details, contact information such as email address and phone numbers, authorized signatory details, business activities, and shareholding and ownership information, and of course other relevant information. Mistake 2. Incomplete accounting records and financial statements. Before preparing corporate tax return, business should ensure that accounting records and financial statements are ready. You should ensure that all transactions for the tax period have been recorded, the trial balance and financial statements have been finalized, bank accounts have been reconciled, customer and supplier balances have been reviewed, fixed asset register have been updated, and supporting documents is available for material transactions. In addition to this, the business must ensure that the financial statements has been prepared as per the IFRS. If the total revenue of a business in a tax period is below 50 million, in that case, unaudited financial statement can be accepted by the FTA in the corporate tax return filing. However, where the total revenue is 50 million or more, in that case, audited financial statement will be required mandatorily to comply with the corporate tax laws. Mistake 3. Not understanding the corporate tax concepts. Many error does not come from numbers, they come from wrong tax decisions. Before filing CT return, you should be aware of various corporate tax concepts and its treatment as per the corporate tax laws. Some of the important concepts to remind and to understand are transitional relief, realization basis election, small business relief election, business restructuring relief, qualifying group relief, foreign and domestic permanent establishment concept, concepts related to the tax laws, qualifying free zone person concepts, participation exemption, non-deductible expenditures, and other important related concepts. Understanding these concepts before starting the filing process will help business to take informed decisions, select the appropriate elections and disclosures, and ensure that corporate tax return is filed correctly. Fourth mistake. People generally assume that accounting profit is equal to tax profit. Many business assumes that if the expense is recorded in their books, it is always deductible for corporate tax purpose. That is not always true. Corporate tax is calculated based on the taxable income and not the accounting profit. Failure to identify the tax adjustments can result in underpayment or overpayment of tax. For example, fines, penalties, certain entertainment expenditures, or some personal expenditures charged to the company may not be fully allowed. If you fail to identify these items and adjust them in your tax computation, you could end up reporting the wrong taxable income. That's why it's important to review your expenses carefully and maintain a separate list of non-deductible expenditure before filing your corporate tax return. Mistake 5. Not reconciling the corporate tax revenue with VAT revenue. Another important area that business should review before filing the corporate tax return is the reconciliation between the revenue reported in the corporate tax return and taxable revenue declared in the VAT return. The problem arises when these differences are not identified, reconciled, and properly documented. Remember that FTA has access to your VAT filings. If the revenue reported in your corporate tax return is significantly different from the turnover reported in your VAT return, it could raise a question during a future FTA review or scrutiny. If there are differences, make sure you have clear explanation and supporting documents readily available to present to the FTA. The next mistake is ignoring related party transaction and transfer pricing rules. Many taxpayers focus on external transactions with their customers and suppliers, however forgot to analyze the transactions with their own related party and connected person, such as partner, shareholder, and director. The CT return also contains disclosure related to related parties and connected person. Business need to maintain supporting transfer pricing documentation to justify that the transactions were conducted at an arm's length, that is, at market rate. Therefore, before filing your return, prepare a list of all related parties and connected person, review transactions with them, and ensure that TP reports, salary benchmarking reports, necessary disclosures are all documented properly. Ignoring this can create a significant compliance risk even for a small business. The last but not the least mistake is poor record retention. Many businesses believe that corporate tax return has been filed, the compliance process is complete. Along with the filing, maintaining supporting documents and records that support the figures reported in the CT return is equally important. This includes the documents such as financial statements, tax computations, invoice, contracts, bank statements, reconciliation schedules, transfer pricing documents, and other supporting documents. If the FTA conducts a review or tax audit in the future, the business may be required to provide evidence supporting its revenue, expenses, tax adjustments, and disclosures. A corporate tax return is not just a form once you submit a year. It is the result of 12 months of bookkeeping and accounting, tax awareness, and documentation control. Business that prepare early don't just comply better, they also stress less, avoid penalties, and stay audit ready always. If you found this video useful, follow for such more business, finance, and compliance related content. You can send me your queries directly, I will answer each of them. See you in the next one. Stay ahead, stay compliant. Thank you.